Hello, everyone. I'm Claudia Leite, and I lead the Oracle Software Investment Advisory Group in Latin America. Welcome to a conversation with market experts on mergers, acquisitions, divestment related to COVID-19 and the trends with what's coming, and also to bring more awareness around IT due diligence and the opportunities that M&As bring in terms of technology transformation. I'm very honored to introduce you to our hosts and guest speakers. Venus Kennedy, the head of Deloitte's M&A consulting practice in Latin America. Mario Anceloni, CEO and founder of In Business and former president of Itaú Tech and HP Brazil. And Diego Stark, partner at the Southern Cross Group, a private equity group in Latin America. And Paula Arias Donato from my team in Latin America, who is going to be helping us here, namely with the Q&A. I invite you all to submit your questions in the Q&A tab. We'll be addressing as much as possible in the end. So according to a report from Deloitte and other sources, in the beginning of the year, there weren't many or much activity, M&A activity expected in Latin America. And then came COVID-19, it came the economic crisis, lockdown, and some companies are in real financial distress. Some have already filed for bankruptcy, and others are still quite robust financially. And so the first may be or may become very easy targets for amicable or even hostile M&As. The ones that are really robust and still with a good cash flow may go after these companies. So I'd like to start by asking Venus a couple of questions. How do you think M&A activity will be affected in our region? How much is it expected to accelerate because of COVID-19? And are there some industries that are likely to be more on the hunter side, while others are more likely to be vulnerable targets?
Perfect. I'm assuming you guys can hear me okay. So the M&A market has already been significantly affected. A comment that I often make in these kind of forums is, one of the cool things about M&A is when things are bad, people sell. When things are good, people buy. But what happens in moments like this, when there's uncertainty, everything stops, and that's exactly what we saw. So if you compare deal activity from the prior period, so that looking at the same period, we saw a 26% decrease in deal value and a 26 decrease in deal volume and a 62% decrease in deal value compared to prior periods. Another metric that I typically look at is due diligence. Because due diligence is a leading indicator of when we're going to see deals close. And compared to prior years, we saw a drop of 40% in due diligences. Now, the good news is that we're already starting to see things warm up again from an M&A perspective. If you look at the period of time that we were looking at, it was this January to April time period where there was a lot of uncertainty. Most countries were in serious lockdowns. And so now we're realizing that we're moving to this new normal. So nothing is completely normal again, but businesses are starting to realize we're going to have to get work done. So how do we work in this new normal? What are some of the commentaries that we've been sharing with our clients around the new normal? There's an even more importance around due diligence, in large part because you don't want to be surprised. You want to have as much visibility as you can on potential cash flows, potential investments that need to be made, potential risk areas. This is not a moment for those kind of surprises. We always say that there's a significant importance of due diligence in Latin America, even more so now. The other comment that we've been sharing with our clients is, I expect, these are actually Venus hypotheses. I look forward to seeing what my colleagues on the panel say. I have a feeling we're going to see a rise in closed deals more towards the end of the year. So for private equities, my gut is we're going to see that more around Q3 because the private equities have significant cash reserves. This is something different than what we've seen in previous crises. And then we'll see more of the strategics doing their acquisitions towards Q4, once again, things stabilize a little bit more. As far as sectors go, I hate to be obvious, but the sectors that have been most impacted are transportation, aviation, hospitality. We saw a big increase in property, and I think that's one that's going to probably stick around for a while, because we're just seeing, I think a lot of companies have realized how efficient it is to work virtually. And there already has started to be a shift to try to reduce office space where possible. We're going to see that go even more. I'll talk about that in another question from what we're seeing executives say around that. And then we'll probably see that those sectors have some significant market consolidation and takeovers in the upcoming months. The only other comment that we typically make when asked about what do we think is going to happen from a deal perspective, specifically in Latin America, because often people say, well, given everything that's happening from a currency perspective, you know, assets are going to be more attractive here in Latin America. And I try to remind people that specifically for multinationals, they have to look at a global basket of goods. And so when you look at the business case, one of the considerations is the risk profile. Now, I don't want to get on a soapbox about whether Latin America deserves it, but there's a lot of focus around Latin America being one of the future hotspots for COVID. And I think as long as there's that uncertainty about what's going to happen in LATAM from a COVID perspective, that risk coefficient will make external multinational investment in the region probably lower in the short term. I think those would be some of my, did I address all of your questions, Claudia?
Yes, you did. Thank you. And Mario, building on the projections shared by Venus, how are your clients reacting to the prices, both the buyers and the sellers? Do you align with these trends, or are you seeing something slightly different?
Yeah, first of all, good afternoon, everyone. It's a pleasure to be here. For you, Claudia, Venus, Paula, and Diego. It's a really pleasure to be here with you talking about mergers and acquisitions. I pretty much agree with Venus. I think that we are seeing a completely different scenario that we saw in the past. Of course, we are service provider, financial advisor in M&A transactions, pretty much focus on the middle market. So we have several mandates now, and we're seeing a little bit of everything now. There are companies, they have a lot of cash, even with the COVID. In some segments, they couldn't manage to raise the amount of cash. So those companies are prepared, and they're going to take advantage. You know, some specific segments. For instance, the healthcare service providers, they are raising more and more cash every day. So they're going to be in a very good position to acquire. So we expect to keep seeing in the healthcare segment transactions moving forward. And it's already happening, and it's going to keep happening. The problem is that what is the valuation now? What is the value based on the current situation? And it's very hard because most of the companies, they still don't know. They're trying to figure out what is the real impact. If the short term is going to be for a long period of time, if the midterm is going to be a little bit different. So right now, one thing that is creating a little bit problems in terms of mergers like this is exactly how much is its value, the company's value. Some industries, on the other hand, they're and we have a customer that suffer so much with this crisis that the business pretty much evaporated. So the company is not worth anymore anything. And it was 6 months ago a very attractive company now. So we're seeing a little bit of everything. And one thing that I heard Venus talking is about the cross-border. And that's gonna in my perspective, and already seen, it's going to be reduced a lot over the next few months. Now, we have this problem all over the world. Companies are more focused on taking care of their own business or their home on their own home. So we're seeing Brazil right now a little bit unattractive for our investments. because of other problems beyond the COVID. And we had already a transaction that was 300 million reais, roughly at the time, $70 million. It was pretty much canceled. It was a company outside Brazil, in Asia. It was everything set to be concluded. Suddenly they decided to abort. And it's not only because of cash, or the press rate, but Brazil itself. So making very short, Claudia, we're seeing a little bit of everything, but it's going to be a game of more opportunistic movements from the strategics, called the strategic, even from the private equities. We know the private equities are very active. Diego can talk a little bit, but they're looking for opportunities as well. Opportunities to buy something cheap right now and to become more valuable in the future. The problem is that some sellers, they will prefer, and they're preferring to hold a little bit until they have a more clear perspective in terms what is the real value of my company under this scenario. I don't know if I answered your question. Maybe I was too long.
No, it was perfect. And actually, now we need to hear from the investor. And both Vida said that private equity are full of cash reserves. Mari was saying that private equity are going to be opportunistic. So tell us, how do you see opportunities or even challenges brought to you by COVID-19, or that you expect to experience in the near future?
Okay, well, thank you. Well, before anything, thanks a lot to Claudia and Paula for the invitation. And it's a pleasure to be with Venus and Mario here, sharing some thoughts in these crazy times, right? So I think the answer has two parts. The first one is in the current portfolio, and the other is new investment. It's important to mention the current portfolio because I think the biggest challenges were there because we had to make sure, as you mentioned before, we were able to cross the bridge and be in the hunter side. So, and for sure, we did a lot of things sincerely. End of March, beginning of April was a total focus on taking care of the portfolio because of all the craziness and taking cash everywhere to make sure we were able to cross the bridge. And once we were able to do that with all the portfolio companies, now we see a lot of opportunities for the portfolio companies, which we're calling a market share consolidation, because it will come either by weaker players that were not able to cross the bridge, and then you can do something. If there is a transaction there because there is some value, you can close a deal, or simply because a lot of players will not be able, not even to start to cross a bridge. That's a pity, but then we'll open up some market share, and you have to be ready to grab that. So this is happening. For sure, we have four companies here in Brazil, but 20 in the portfolio in Latin America. And all companies, we have a lot of Just to add another good thing, because the COVID has good things, right? We are spending more time with the kids and things like that. But for the companies, we were able to push a lot of transformations that, when you have a stable situation, you take more time to take some decisions. Now, you can move much faster. So this is on the portfolio. On new investments, which is fresh money, and when we do have some money, especially on the new fund that we have, we see a lot of opportunities because this is the perfect storm, right? We have a situation where you have margins being squeezed, we have companies, we have very high leverage, and a strong dollar. Our fund is in dollars, so we are in a very so if you're in this position, we really have a lot of interesting situations, and we're checking a lot of opportunities. The only thing that is really different now is that we usually do growth cases, and right now this is not the story. The story is kind of a special situation. Sincerely, unfortunately, there are a lot of companies, as Mario mentioned, that there are some companies are beyond repair because the equity is not there. It's so much leverage. You know, the EBITDA is it's non-present, so it's very hard to find and to cut a deal. But in other situations, people are still, they have something left, and then you can do something on a more structured deal. And sincerely, this is the things we are looking at. We have to be creative. We have to be, you know, have to think about different structures. It's not just, you know, paying cash. It's there is a lot of earnouts and convertibles, things like that. But sincerely, this is a buyer's market. This is for new investments. It's unfortunately it's not bad. It's not bad at all. But one thing is for true that we're going to cover in the next question. Due diligence to understand what we're getting into, it's always important, and we'll cover. But it's even more important now because, again, when these crazy times come, people overlook a lot of things, and then you have to see what you are standing at. So anyway.
Yeah, absolutely. So you helped me introduce our next topic, which is actually due diligence. And from my own experience, greater transparency and clarity offered by due diligence really is vital during an M&A process. And my team has been providing important information around Oracle assets and Oracle contracts to customers that are undergoing some sort of acquisition, divestment, and we realize that IT due diligence in particular is very often overlooked, both by the buyer and the seller, and this can bring a lot of technology and legal risks and liabilities. So Mario, you are president of 2 large technology companies in Brazil, and you had to deal with several acquisitions during your tenure at both firms. So what were the biggest pains that you faced with regards to the technology and also the IT contracts that came along with the acquired firms?
Yeah, it's a good question. Yes, I had quite an experience with, I was to say that the only thing worse than integrating technology, or particularly IT, is splitting it. It's even worse than integrating. And I had the opportunity to do both, to deal with both. And of course, as when I was an executive, as you mentioned, the president of technology companies, we did some transactions. And of course, now that we provide advisory service for M&A. And I think that usually, you mentioned something very important. Usually the due diligence for the IT infrastructure as a whole, or technology, we have to split this technology, the back office and the front office. You know, the front office, when people are much more excited because it's a value generating asset, and the back office usually is not a value generating. It's more the potential value destructing asset now. So usually people try in any kind of due diligence to take a look more excited about the value generating process. And when it get to the IT, most of the people, they don't even want to look at it's something like, okay, leave it behind. And that's a big mistake. Now, big mistake. So one thing that we have learned is that we need to take a look at IT in a very structured, and preferably hire someone, a company that can provide service, understand this very has a deep knowledge and experience in evaluating the real integration or splitting, whatever is the process. Let's talking about more common is integration, because this can probably not going to add value to the transaction, but at least you have a very clear perspective of how much money you're going to have to put on that, and how long it's going to take for you to really have the final solution. And even more important, sometimes it's an opportunity to start from the ground, because we have something that both companies that puts this way, one acquiring the other one, take a look for, you know what, neither system is going to be fine for me. I need a completely different one. So it's a great opportunity for you already starting planning integration that in the end is going to be something different. So we had been through many difficult situations, but for me, one was the key every time is that we had people on our side that really understand and help to plan an integration process involving not only the assets, but you mentioned the contracts, the relationship with the suppliers, the people involved around it. So it's not only the asset itself, it's the whole ecosystem that need to be taken care. Because again, it's not going to add value to the transaction, but can potentially destroy a lot, but eventually can become something more relevant in the future if you plan strategically. I don't know if I answered your question, Claudia.
Yes, perfectly. If I were a buyer, I would expect to buy a company that is fully operational, and all the risks would have been uncovered by due diligence. Diego, is this your experience from investing in businesses across Latin America? And even, are there some differences between Brazil and other countries, for instance? And what kind of hidden costs associated to IT did you have to or have impacted your M&A transactions?
Well, that's a good question. Yes, this has been my experience in the region, and sincerely, the difficulties are the same. Sincerely, if you do a poor due diligence, you're gonna buy some headaches in the future. Sincerely, that's and you mentioned people when think about due diligence, think about the business, the legal, the audit, and they kind of tend to forget about the IT. And sincerely, IT is a neighbor for everything, because you are a private equity, you put out the amazing business plan for 5 years. And the biggest cause is that if you have the wrong reading of where the company is standing, then in the end, it's going to take much more time and much more effort to take the company where it should be. And that hurts the returns, right? It takes more assets from the fund and things like that. So I would say that there is you should not save money on due diligence, for sure in IT, but in any due diligence, because it's a good insurance. For at least you cover a lot of as much as you can during the process. Now you mentioned we don't have a problem. Again, in my company, sincerely, our mandate is like taking a company, what we call the version 1.0, taking to the 2.0, and then selling to a strategic. This is part of our game. So we went through a lot of new ERPs, and it's a nightmare. But it's not a problem if you are planning for that. The problem is that it's when you don't know that you have to transform something, and that's the big problem. So anyway. It never hurted us. We never stepped down from a process, but sometimes took much longer, as I mentioned before.
I get it. And so, Venus, what is your advice? What would you recommend to both sellers and buyers with regards to due diligence, IT due diligence, that would help reduce or eliminate the unexpected liabilities that usually come to the surface after the transaction is completed?
Perfect. So this is a question where I loved being last, because hearing Diego and Mario, they said a lot of what I would say, and it's even better hearing it from clients than when you hear it from a consultant, because my main advice is do IT due diligence. I mean, Diego, you said it perfectly with, you both raised many points that I was going to cover in my section. But for example, Diego, you said it's okay if you have to make the investment, but only when it's contemplated in the business case. When it's a surprise, that's going to be where you see a big destroyer of value. So, we're trying to educate clients exactly on that not just financial and tax due diligence matters. IT is really, really critical, because it's where my part, I didn't really do much of an intro in the beginning, but a lot of where I support is actually into integration or the divestiture. So the really hard work of that 6 to 9 month period afterwards. And really, without a shadow of a doubt, the biggest pain point, if I were to pick one area that has most of the pain points, it's always IT. And a lot of those pain points could be identified earlier in the process as a result of due diligence. And if you did the due diligence right, you could actually build it into the value of the deal. So any required investments that need to be made, any potential risk points, it could be built in right from the very beginning. And it could actually be a potential way to create value instead of destroy value if you did it right. As I mentioned, IT is one of the areas with the most complexity. It's where you see most transaction service agreements, so TSAs. And actually my point there on advice would be, one thing that we've been telling, if you're doing a divestiture, is we've seen deals fall apart because of the immaturity of the buyer, in particular around IT. Okay, so an inability to absorb this new company into their IT structure. And so then that would mean that the seller would have to continue to support a number of things through TSAs indefinitely, which is not what you want to do. And so one piece of advice that we always give sellers is to look at that, the maturity of the buyer to integrate, specifically around the IT systems. Other deal breakers that we see, or actually before I go into deal breakers, I'll talk about the 4 pillars in IT due diligence. So one is around the IT organization and the processes, so how IT is set up to assist the organization. IT strategy, projects, and spending. Sometimes we see companies say, listen, you can't make any investments while we're in the process of doing research, so that you don't buy a company that has a significant cash flow around IT investments that might not be necessary, but that might also be creating risks where you have a destabilized system in that interim period. So trying to understand what are the costs, what are the potential investment costs that would need to happen. How the systems and the software enable the organization. So here you would want to make sure that you don't have proprietary software that's not going to come with the deal, but that would break apart business processes on day one. And then finally, infrastructure and IT security. Cyber risk, those have become a very big deal in recent years. And so there needs to be analysis of where are the vulnerabilities from a risk perspective. That's not just cost, that's actually impacts to business continuity that have to be understood and built into the cost of the deal and your day one plan. And so, like I said, some potential deal breakers a good IT due diligence can help you avoid is significant investments that would invalidate the business case of the deal, or as I mentioned before, maturity of the buyer that would make the execution process take much longer than necessary. Those would be my key comments.
Wonderful. A lot of lessons learned. Yes, Mario.
Can I add something? Because first of all, I love it hearing Venus talking about the structure that Oracle has for this kind of thing. Because one thing that we have faced is that even when, and of course, the buyer, it's a must for a buyer to do a strategic due diligence on the IT, because and there is still a lot of resistance for that, and especially when they do, some of them they prefer to do with their own internal team, and that's a big mistake, because they want to see just a more operational, tactical, and you need to take a very broad view of the IT. And not only the operational or the short-term risks, and I said, but how can we really evolve? And if you do that in advance, you're going to know we're going to be in a much better situation in negotiating the contract, and also know how much you're going to spend, how much time it's going to take for you. So I'm glad to hear you talking about Venus, but we need to keep talking to them, particularly the buyers, because for me, a buyer who doesn't do an IT strategic assessment, not only due diligence and planning, is making a mistake. Is not investing the money. This is an investment. Should not be considered as an expense in an M&A transaction.
Would you agree, Diego?
Completely agree.
I completely agree with that. And I think it's interesting discussion, because we tend to think IT as a black box, right? Before there was just the IT kind of the infrastructure, which is relevant. Okay, so just check if the enabler for all the areas to run are there. So make sure you have the right system, the processes, and if not, as mentioned before, that's okay, because then you have to invest the money there. The second discussion is because now everybody have to be digital, right? And now the discussion is sometimes one of the big levers for value creation is going digital. So again, it's another difficult, and this is another discussion because you guys know being digital, it's a cultural thing. It takes more time. You have the right human capital to do that, and the structure. It's not the IT under the CFO. It's IT under the CEO. It's completely different, right? So we are now seeing these discussions much more, and go exactly what Mario said. Perhaps this is the deal. Perhaps you have a perfect company now, which is 1.0 in terms of just selling on the same channels. I'll have the opportunity to move to them. But anyway, so fully agree that, and as I mentioned before, it's the best money invested because saves a lot of headaches and so on and so forth. But anyway.
All of this is music to my ears. What the three of you share.
We never talked before, right? It's the first time ever. I'm just kidding.
It really reinforces my belief that IT should play a more strategic role, increasingly strategic role in all these transactions. And it offers as well, and you mentioned it, Mario, in your first intervention, that and Venus as well, it's an opportunity. M&As offer an opportunity to realize greater value from the investments, the existing investments, but also to plan for future investments in technology, to think about infrastructure refresh. It could be just digital transformation, new systems, adopting the buyer system, or even the seller system could be even better. So let me start now with you, Diego, with this next question. What role does IT play when your private equity group is deciding on acquiring a new company or even divesting in a company that already is in your portfolio? So really concretely, how much IT is important? Because we think about M&As, there's something strategic about the business. Healthcare is going to buy probably a company that is related to healthcare. But because technology is becoming the base and the platform for everything, so how do you, private equity, look at technology when you are, it's not just the ERP system, but when you are deciding on your future acquisitions?
Well, this is, so when we make an investment, we have a very clear strategic plan for that asset. We say, well, as I mentioned before, we are taking for version 1.0 to 2.0. We have to go and have to do that in 5 years. So IT, as we see, is crucial to deliver this plan, because we have to know where we're standing. So how we have to improve the operations, how we have to improve the commercial area, and sincerely, all the other areas, everything plugs in a system that you have to understand. And again, everything that you miscalculate or misunderstand, that affects, as I mentioned before, on your plan, and then in the returns, so on and so forth. The second thing is that we need information. We as a private equity don't have a lot of time. We just have 5 years. And seems a lot, but it's not. It's nothing. 5 years goes very fast. So we need timely, accurate, and accessible information to measure, and especially in this region, right? Things change every day, perhaps every hour. So how you adjust considering the plan you have. So let's be very simple. If you have the results of the month in the 20th day, it doesn't help that much. You have to in the third, fourth day. So it's that simple, sincerely. But it's not that simple to have passing from day 20 to day 3 or 4. But it makes a huge difference, because the only thing we know is that you have a north, you have to adjust. It's not linear, right? It's like this all the time. And finally, this is when we decide to buy a company and to do the transformation. On the exit side, this is interesting. We usually, given the profile of our fund, we usually exit to strategic players. And imagine that the strategic player is usually an American company, European or Japanese or Asian, or so what they want is a smooth operation and a plug pay operation. For sure, they want to grow, but they are thinking about the company for the next 20, 30 years. They don't want to mess, with things that don't work. This is our job, sincerely. That's why if we have a bad due diligence, it's hurt us on fixing it, because in the end, if we don't fix, it's gonna hurt our exit to the strategic player. So yeah, that's it. It's IT. We really take care. We really look a lot. Just to give an example, one of our partners is an IT expert. We don't pretend to know anything. It's just, since we don't know that much, we brought someone that knows, and we use a lot of help from consultants to cover and to decrease the number of surprises. Because interesting enough, surprises here is always hurt our returns. There's never positive surprises, our negative surprises. But anyway, so that's it.
That's good, thank you. And Mario, what is your view on technology becoming more important for M&A decision making?
Yeah, I think it's becoming more and more important every day now, because M&A is all about generating value. Now, it's going to be a private equity, it's going to be a strategic, but when you do an M&A, you're looking for value creation, value generation. Now, can be immediately, can be over time, usually over time. So, and nowadays, when you're talking about value and you're talking about the ability for you to expand the business, to really extend the relationship with your customers, there is no way you can do that without technology anymore. And the COVID right now is just an example. We are here in a platform now, in a technology platform, talking to a lot of people, and it's going to be more and more frequent. So technology is progressing and becoming even more relevant to the daily activities and in every single aspect. Now, so when you're talking about the in M&A, we need to take a look if let's suppose you're a buyer now. And if you're going to buy your technology that you're going to be acquiring is a business enabler or a business blocker. You're not talking only about the asset, because the asset is pretty much easy. We're talking about the people around it. We're talking about the process, risk management process. Nowadays, how you manage the risk associated that something goes down. Now we strategy. So it's going to be more and more IT being checked as one of the strategic elements in the decision-making process. I'm not sure if it's going to be it can become eventually, and we've seen already a deal breaker. But I see more and more things that we're doing here, discussing strategically IT in an M&A transaction, more relevant and more usual every day, as Diego mentioned. Even they are investing in people who have more IT expertise, but not the guy that runs the database or do but the guy that can think about strategically. So making very short, yes, more and more, but it is in a strategic way, not in a tactical, operational that was treated before. But in a more, can really move, take or explore or extract more value from this company with this IT environment or technology environment that we have, or we need to do something different in order to really extract the value. No, so that's the way I see it.
Yeah. And Mario, are you already seeing this starting to happen?
Yes, yeah. See, as I mentioned before, is it starting to happen? We need to be more. People are getting more. How can I say? Conscious about the role of the IT or the technology and especially now, living. Now with this mess or this crisis that we are facing, people are putting much more attention on the technology. But again, not only but it is starting in a strategic way. We're going to see more and more this, and eventually it's become a real part of the decision-making process, and it's going to help everyone because the seller is going to need to invest in something a little bit different if he wants to sell or she wants to sell the company in the future, and the whole ecosystem is going to be benefited.
Yeah, that's a good point. And Venus, in your opinion, how could IT actually be elevated to that more strategic dimension when considering M&As?
Perfect. So I think they already covered significantly that people don't do it enough, especially if you think about IT just as an enabler. You're going to create risks, fine. But the market and the movement has already changed. So one thing that I didn't talk about that I meant to earlier is we at Deloitte, we're talking about how we're changing the definition of M&A, that it's not just about buying and selling anymore. It's about alliances, it's about joint ventures, it's about other ways of doing deals to achieve kind of the same strategic goals. So for example, digital is something that's very, very important. It's the new kind of sexy word. And before people looked at, do we want to build or do we want to buy? Well, there's now a third option, which is alliances and joint ventures. And so being able to think about IT strategically, not even just by buying the technology, about who do you create alliances with. For example, Oracle is a perfect example of a company that benefits from this alliance model. I think another comment that I would make is, we've been doing a number of studies around what are we seeing as trends for the future as a result of COVID. So we're seeing an accelerated digitalization, 72% rise in fintechs in Europe. We're seeing increased virtualization. So 74% of businesses plan to keep employees out of physical offices, even after COVID. And so that's going to really change how we use technology to enable business and to drive business performance. And I think the other comment that I would make is M&A can be a great opportunity for digital transformation. So I have a lot of examples, depending on the size of the deal, of course. If it's a tuck-in, this isn't relevant. But if it's a big divestiture, then you can use this as a moment to streamline your organization. Flex Cloud solutions is something that we talk a lot with our clients about maybe you don't need to have this stuff in-house. Maybe you can start to outsource more of it to continue to be on the bleeding edge. Or it could be an opportunity to drive changes like I just supported a multi-billion-dollar deal here in the region last year, and they used it as an opportunity to introduce robotics to lower their costs, right? And so using artificial intelligence, using robotics, using this moment of already having a significant amount of change to ride the wave of digital transformation, really using technology to change how you use, how you perform your business. And then I think the only last comment that I would make about thinking IT strategically is cyber or risk, just in general. We've seen a number of headlines in the last 2 years where failures from a data or security perspective has created brand impacts and significant costs because they weren't addressed. And so I think these would be some of the some of the things that good business leaders are thinking about from IT beyond just as an enabler, but around how can they really propel their organization forward.
Awesome. Really great. I don't know, Diego, if you or Mario want to add something before we go to Q&A.
No, I think that's
yeah.
Great. So I want to remember our audience that you can still ask questions. Just use the Q&A tab. I believe we already have a few. So Paula, could you please tell us what is on?
Sure. Well, thank you for the time here. I have a question for Venus. You mentioned the impact of proprietary software in the merger and acquisition deal. In that matter, how important is it that the seller company has a software asset management policy in place?
Okay, so one of the things that we talk about is how important it is to have a policy to track and control the changes in the proprietary software. So for example, if it's tailor-made for the company, understand what are the features, what are the customizations, what are the processes. Okay, those need to be understood in advance to understand the ability to merge it into your organization. Also understand the other modules, the other systems that all feed in to it. Because I loved what Mario said around the only thing worse than integrating IT is separating it. And so understanding all of these dependencies and how they link would be another thing that I think would be critical to prepare yourself from a proprietary software perspective on M&A. Did I answer the question?
Yes, thank you.
Okay.
Okay, I have another question. How difficult is it to engage CTOs from both sides of the deal and make these professionals understand how strategic they are to the success of the pre and post M&A?
Can I take that first?
Sure.
Sure.
First, very hard for you when you're in the middle of a transaction to put people from both sides, because usually, let's put it this way, now, so you're talking about two companies of the same size, or it's going to be where you know that only one's going to survive. It's very hard to engage people from both sides. So usually not a good idea pre-transaction, because that's when people usually trying to show their basic instincts, that survival. Now, so the reason why I recommend not to do this, honestly, recommend to hire someone, a professional company, experience with people that are used to. And I'm talking about, because my company doesn't do that. It's exactly the opposite. We wanna help from companies like Oracle, for instance, that can help with IT, because that is not the time for you to really get emotions involved. And when we are in a pre-M&A transaction, the emotions are very high. You need everything but emotion. You need a more rational, strategic approach to really take a look, but not only, as I mentioned before, not taking a look only in what we have today, but how can we build something more powerful from what we have in the future, to extract more value from that transaction. So I think that's Jefferson that asked the question. So Jefferson, I don't think that's a good idea. Although it would be great, but usually people now, a lot of emotions, try to dispute, to see who is the one who has the brightest idea. Very complicated. They can really jeopardize the deal. So don't do it. Hire someone, a company very reputable with a lot of expertise. They're going to be a much better job in this process than putting the CTOs together. No?
Diego, you wanted to
May
May I? Oh,
yeah.
go.
May I? Oh, sorry. You want to go, Venus?
I'll go after you, but I definitely want to add something here.
No, it's so funny because I'm just coming from about 1 year ago we went through a merger, and we did exactly what Mario said, because what happens that each company has a systems whatever, and they are their babies, so they can defend as much as they want. So there is no upside in this discussing what is the best. So what we decided to do is put a neutral. We hire a consultant, and they did the due diligence. They said what was the plan for the newco, and then they say, well, what you guys need is this, which was not even what coming from A or B. So it was parts coming from one company, parts coming from the other, and to get it started, and then to start a transformation. So it's impossible to do that with the people in the companies involved. So it doesn't sincerely help in the M&A process, but definitely help afterwards in making things work, because Monday morning you have to you have to work, right? So, but anyway, it's exactly what it's so funny, because exactly what I went through.
And if I could add a point of view, and I know it's not ideal to have 3 people answering every question, but I really, so I think a couple of things. So first of all, it's interesting to hear you guys have that perspective, because I guess anytime I'm involved, it's because I'm there as a consultant, so an impartial third party. So I don't get to see the opportunities where they didn't hire somebody. But our best practice, or what we recommend, is is, assuming that you've hired a consultant, is to have somebody representing both sides. So you have somebody from the buyer, somebody from the seller, because if you don't, you really have an opportunity of missing things. Now, for that to work, you have to go one step before, and you have to have what we call integration principles. So are you going to try to do the best of both? Are you going to, when there's a doubt, are you going to go with what the buyer is doing? You have to have some guide rails so that when these tough discussions happen, you're not wasting time. So if the guide rail is, look, we're going to do what's cheapest, or we're going to do what the buyer has because we can't move this company over to what you're doing, then those conversations are easier. And then by using both of the CTOs, you make sure that they're not things missed that would be if you only had one side of the party in the conversation. I think that would be the only thing I would add.
Great. I think we have new questions, Q&A tab.
Yes. I think we have time for one last question.
We have for a few more.
Okay, great. So the next question we have is, how can the IT management impact the financial health of the acquiring company?
Say that again? How
can the IT management impact the financial health of the acquiring company?
I think that's one we covered a lot.
Yeah.
The answer is a lot.
A lot.
A lot.
Significantly.
But I would just mention one thing. I think this is just adding on that. Impacts a lot on when you have and the quality of information you have to make the decisions that I mentioned in one of the answers. Because in the end, you have to know what is happening as fast as you can to adjust. If you are late, then things could be a problem, and then can impact. They can have very big disasters, sincerely. That we just went through the COVID, and the COVID showed that everything can change overnight. So if you have the wrong information, then can be painful.
Paulo, I want to add something is that because I had a lot of experience dealing with CIOs and IT managers, CTOs as an executive, and also nowadays representing my customers, and usually I talk to the owner, the company owner, or the CEO or the board. And one thing that that we always usually we get into a deal several months before the deal happen, and usually helping to structure the deal before. In some cases, help to prepare the company, and in a very good way. I was not preparing in a bad way, in a good way, to really taking care of, help the company to become more attractive to the market, to a potential buyer, or usually we work more for the seller, and helping the company to have a better price. And we always talk about to our customers about the quality of the IT team, not only the IT manager, whatever is the title, because this team in particular, led by someone, he, CIO, CTO, whatever the title is, can have a big impact in how the company is going to be putting making the necessary investments, and really preparing the company to become more attractive, to become more friendly when an acquisition occurs. So but I think that the relevance of the IT team, particularly the leadership, is critical. Is critical to really enable a more smooth transaction, or creating something like, as Diego mentioned, painful after the deal happens. Now, so whoever is listening, if I can give an advice, if you wanted to enter in an M&A transaction in the future, selling your company or in a selling position, take a look in your IT team. It's going to make a huge difference when the time comes. No?
Yeah, indeed. One more question, Paula. Let you choose.
Thank you. So this question is, how important are CapEx and OpEx costs associated to IT in the decision-making regarding buying a company?
Is it something that a buyer looks at? You know, the balance between CapEx and OpEx?
A lot.
Well, I
Yeah.
can give a first cut. Well, it depends on the plan, right? I think Venus, she mentioned one example. Well, you can put robots, you can put a robot CapEx to decrease the OpEx. It makes sense. For me, well, if it helped my returns in the end, then I'm willing to do the investment. So everything depends on the case, but
Your objective.
but I think to be, yes, we have to look at that, because this is one interesting aspect of I think Venus mentioned as well. The digital now is kind of, everybody's digital, right? But we do have amazing time. So we have these capabilities. We have a lot of CapEx that we can do in this type of connecting. Then you save on the OpEx from flying, and you have the IoT coming in. So for instance, we have one company that have 9,000 pieces of equipment. So I'm willing to do all the CapEx because, wow, that's a lot of, helps me a lot of in improving returns from each piece of equipment. So again, depends on the plan that you have. Sorry, that it doesn't have one size fits all.
And
but we definitely take in consideration.
No, I was going to say, I think it depends on a lot of what's happening with the specific customer, right? So a lot of what I do is for strategics, but that example that I gave, it was an industry where they had big peaks and big valleys. So they were in the middle of a peak, so they were very cash heavy. So they said, look, we're going to make some investments so that we can lower our recurring costs going forward. So that made sense for them, because then when there were valleys, they had lower costs. If you have a company that has a different cash position, then you're better off with less big expenditures up front and a more stable operating cost. So it really kind of depends on your strategy and how IT and the CapEx, OpEx can help support that.
May I add something?
Sure.
I don't think it's more CapEx and OpEx, but how the money is expended. If because what they look is that, okay, we need to reduce maintenance. Money spent on maintenance, and more increase money on innovation and money to generate more efficiency. So it's not only the CapEx and OpEx, but how the IT money is really expanded today, how they could shift it. So the more and more expectation that the money flows more into innovation and efficiency. This efficiency can be internally, can be externally, in relating or enabling more business for the company. So it's not only the CapEx, OpEx, but how is strategic, like Venus said, the money is used versus more operationally speaking, and it's becoming more and more relevant. I wouldn't say in the decision-making process, but in the evaluating the whole company, because it's not only about the cash flow, but how is the strategically the company thinking makes some difference. No?
Yeah, absolutely. Well, I think we've arrived to the end of this conversation, and I hope it sheds some light and offers some insights on why it's important to really increase awareness on the importance of technology and IT due diligence when we're making decisions around mergers, acquisitions, and also divestiture. And if you're interested in learning how Oracle Software Investment Advisory can support you with IT due diligence specifically for your Oracle assets, your Oracle contract, don't hesitate to contact me or my team in Latin America, or even our teams around the world. We have teams everywhere in all the regions, especially if you have operations in other regions, we'll be happy to help you. And at the end, when this webinar is over, you'll be asked to answer a very short poll to let us know what you think about this webinar. And I want to thank you, Venus and Diego and Mario, very, very much for your contribution. I've learned a lot from you today. It's been a lot of fun as well. So I wish you all a great day, and bye-bye.
Bye, Claudia.
Thank you.
All
It
right,
was a
thank you
pleasure.
for the
much.
opportunity.
Thank you, everybody.
Bye.
Take care.
Bye.
Bye,
Bye,
Paula.
Mario. Bye, Venus. Bye, Paula.
Bye, guys.
Bye, everybody.
Bye.